Today, I want to discuss how do rising interest rates affect real estate? It's a great question, and by the end of this video, I'm going to help you understand how rising interest rates affect real estate investors, but also what you can do to overcome it and profit from it. Have you ever wondered how important real estate interest rates are when it comes to investing in real estate? Have you ever wondered or you're curious about how some real estate investors absolutely crush it regardless of what interest rates are doing? Well, let's dive into this by first explaining what real estate interest rates are. Next, I'm going to explain how rising interest rates affect real estate. And finally, what I'm doing right now that is absolutely crushing it, and it does not matter what interest rates are at. If you're ready, let's go. In real estate, an interest rate refers to the percentage a borrower has to pay to the bank to borrow money in order to purchase a piece of property. Essentially, it is the price for taking out a mortgage, and that directly impacts the amount of monthly payment that the person has to make, right? So if you have a higher interest rate, your mortgage payment is going to be higher. If there's a lower interest rate, obviously your mortgage payment is going to be much lower. But here are some things about interest rates that affect individuals and the economy. Obviously, higher interest rates are going to impact affordability. Now think about it. If interest rates are high like they are right now, the ability for somebody to purchase a home that's above a certain amount goes down significantly, right? So if somebody has budgeted to purchase a $400,000 home and interest rates are right now at 6.5% for a 30-year fixed, obviously, the monthly payment that person has to make on a $400,000 home is much greater than it was 3.5 or 4 years ago. There were people that were buying homes that were $600,000, $700,000 that their payments right now are less than somebody that's buying a home at say $350,000 or $400,000. It's crazy, but that is how impactful interest rates are when it comes to your monthly payment. Interest rates are also affected by market conditions, economic conditions, and even the credit score of the borrower, right? So if somebody has maybe a bad credit score, the bank is looking at what is this person's ability to pay back this loan, and if it's not great or they've had some trouble in the past, they're going to have a higher interest rate than somebody who has a perfect credit score. And there's two types of interest rates. There's fixed, which means it'll remain the exact same interest rate throughout the life of the loan. So those people who locked in like a 2.5% interest rate 3.5, 4 years ago are sitting pretty, they're extremely happy. And then there's a variable interest rate, which means that the interest rate will vary depending on current market conditions. So those people who got a very low variable rate 3.5, 4 years ago are now experiencing some pain because their mortgage payment is much higher because the rate varies. So obviously interest rates affect monthly payment, but here's something that a lot of people don't understand about interest when it comes to real estate investing. Many times when a mortgage company borrows you money and you are paying a mortgage payment, you're paying both principal and interest, right? That is a mortgage payment. Now there's other things involved with that. You got to pay insurance and taxes. And a lot of times those are all baked into one payment. And then the mortgage company will go ahead and divvy out or disperse the insurance payment to the insurance company and the property taxes to the taxing authority. However, the principal and interest that an individual paying is going to the mortgage company, right? Because they've lent you the money, the bank. However, here's what some people don't realize, and it's actually a little bit scary if you think about it, but it's always been set up this way, is over the course of a loan, typically a person is going to pay as much or more than the cost of the home in just interest. So if you have a 30-year mortgage and the cost of the home is $300,000, over the course of 30 years, you're probably going to pay $650,000 to $750,000 for that home. Now, the bank is lending you money to have the home. They have a right to make money off of that. But another thing a bank does that most people don't realize is they front load the interest, meaning that that payment you make in month one or year one of owning the property, nearly 95, 98% of what you're paying every single month is going towards interest, and that 2 to 5% is going toward principal pay down, right? And why do they do this? Well, one of the reasons they do that, because if you refinance your property, say 3 years from now, 5 years from now, they are going to make all that money from interest, and the amount you've paid down on your home is going to not be that much, and you're going to reset that 30 years, and you're going to start paying a bulk of that payment again towards interest versus principal. That's why many people that are in the financial wellness space will tell people to make extra payments on your mortgage to pay down that principal, right? Other people might say, you know what, if interest rates are low, don't even worry about it. That's the cost of doing business. But it is interesting to note and to understand how that works from a bank's perspective, so you as an investor can make informed decisions about what to do with your money and where to invest it. That's why interest rates can be really interesting as an investor, right? There's two things you want to consider. Number one, what is the current interest rate and how much can you afford based on the current interest rate? However, if you're a real estate investor, one other aspect to look at is what can you make on that investment that you're purchasing, right? And so if interest rates are high, but you're able to make a cash on cash return of say north of 10, 12, 15, 20%, that's actually a really good investment, right? When we bought my vacation home in Orlando, Florida, close to Disney, I got a good price at it and interest rates were low, but if interest rates were higher, I'd still be making north of 15, 16, 17% cash on cash return on that investment, which is pretty dang good if you think about it. Where are places in the world that you can make that type of return, cash on cash return? There's very few places. So that's another thing to consider, because that might make it where interest rates aren't that big of a deal if you have that type of investment. So how do interest rates affect the economy? How do they affect real estate overall? Well, in a couple different ways. Number one, if interest rates are high, you have a lot of people that are timid or a little bit cautious about investing. So market demand is going to go down. The demand to invest in real estate is going to go down naturally. And now obviously, if interest rates are lower, you see demand start to go up in people that want to buy pieces of property, right? And so if demand goes up, obviously prices go up. If demand is low, prices will come down. However, we're in a very unique situation in today's economy where demand is low, but prices are still high. That's because supply is very low. There's very little supply on the market when it comes to real estate, right? So because of that, when you have low inventory, prices will remain high. If you have tons of supply, tons of inventory, prices need to come down in order to be able to move that property. So if you look at interest rates, currently today, the current interest rate of a 30-year fixed mortgage is 6.5%. On a 15-year fixed mortgage, it's 5.85%. And absolutely, real estate interest rates affect real estate, right? People get excited about it when they are down. When they're up, people are a little bit more nervous. But what if I told you there's a strategy that it does not matter what the real estate interest rate is, and you can make cash flow every single month as well as build wealth? Well, that's a strategy I've come up with over the last 12 months that's absolutely innovative. It's brand new. It's called cash flow flipping. And if you want to understand how to do this strategy step by step, click on the full video below about cash flow flipping. Thanks for stopping by. Have an amazing day.